Welcome, John. Nice to see you again.
Thank you, Carl. Good to see you.
Well, I want to first congratulate you on a magnificent 2024 and the launching of municipals at First Eagle. You had an amazing year performance-wise. You built a whole team. You aggregated some $5 billion in assets for the firm. And I wanted to kind of go back to the beginning for a second and have you maybe talk about the entry position that you came into and then maybe juxtapose how you're seeing the market today, 14 months later.
Unquestionably, in January of 2024, the municipal high yield market, I thought, was attractive. And we believe that we accessed many of the best opportunities available at that time, yields at or north of a 6% on average. As you take a step back and look at the market today, I think it's very interesting because even though the Fed cut rates by 100 basis points between then and now, and short-term interest rates fell commensurately, longer-term interest rates from 10 years on out to 30 years for AAA municipal bonds actually went up. So they are higher today than when we started. Then for high-yield municipal investing, of course, you have to look at the credit spreads, the amount of yield you're adding over and above that AAA rate. And credit spreads are in the same general neighborhood. I think that it's very important to look at the dispersion of those spreads as opposed to just the average. So broadly speaking, the average amount of incremental yield for a high yield municipal bond hovers around 200 basis points over the AAA. But that doesn't tell you everything that you need to know about the dispersion of the opportunity set. And that could be with bonds trading anywhere from 150 basis points over the AAA on the low end to as much as 400 or 450 basis points above the AAA on the high end. And we endeavor to select, the best opportunities at the higher end of that overall range. So net, as a result, we're still looking at an opportunity set in the 6 to 6.5 area for many of the things that we are working on now. And I think in an environment where inflation has come down, we think it should be able to come down a little bit further to meet the Fed's goals. That, call it 6-handle opportunity set, I think looks very attractive in the tax-free arena.
So we're hearing a lot in the news last few days, particularly on tariffs. Maybe more relevant is, do you have a view or an opinion on where we're at with inflation, which is really what the intrinsic fear is?
Yeah, I think that's really the most important thing for the bond market. And holding tariffs to the side just for a moment, what's been encouraging is that we're still in a very gradual disinflationary trend. I mean, inflation has come down all the way from 9% on an annualized basis for core PCE, all the way to 2.5%. And of course, there's that last piece that the Fed is very interested in and very dedicated to getting that 2.5% core inflation rate down to 2%. I do think that is gradually occurring. A lot of that differential is coming from the housing market and from rent, and the translation into the government data is owner's equivalent rent. Owner's equivalent rent is a very lagged statistic. It's about 6 months old. The anecdotes and the market data that I'm seeing suggest that the housing market is cooling a little bit in most areas of the country. Rental rates are not having dramatic year-over-year increases. And maybe it takes a few months for that data to filter into the government data. But that's a very important component of both the PCE and the CPI. And I do think that it is trending gradually lower. Now, the Fed has said they're not in a rush to do anything because they don't know where the tariff situation and negotiations and daily announcements are going to settle in. I will say the American consumer really adjusts and they can move away from things that have increased their prices dramatically. And there undoubtedly is a lot of negotiation going on behind the scenes. So we just don't know where that is going to land and for how long and on which products. But I'm optimistic in the overall flexibility of the economy and the American consumer.
So maybe we can shift a little bit about then to municipal financials. So you've seen 25 years of munis from high yield to investment grade and different market environments. How are you feeling about the financial security of the municipal bond market and particularly high yield today?
A couple key things to watch because economists have generally started to downgrade their growth forecasts for this year. Still in the 1% to 2% growth range. I would say previously forecasts were the 2% to 3% growth range. So downgraded, but still positive. A little bit of creeping talk of, is there greater recession risk this year, from very low probability of a recession to slightly more meaningful, but below 50%. So perhaps a little bit of a slowdown environment depending on what happens to the job market and the consumer spending. I would say the economy overall is pretty resilient, just probably growing more slowly. How does that environment relate to municipal credit? Well, I think municipal credit is heading into a potential slowdown in really good shape. I mean, we've seen the prior 4 years of the Biden administration, municipalities were absolutely flooded with cash, record amounts of cash from a variety of different government programs, initially to get us through COVID, but then subsequently to increase infrastructure spending and things like the Inflation Reduction Act and the American Reinvestment and Recovery Act added to that. So as a result, municipalities still have very close to record days cash on hand, very close to record rainy day funds. Their own revenues from state and local tax revenues like property taxes and income taxes and sales taxes are running above $2 trillion. This is just at the state and local level, not the federal level. And that's a very robust flow of funds. So I think that the overall default rate, I should note as well, in 2024, only 1.5 billion of munis hit a first-time payment default in the year 2024. So that's a very tiny percentage of either the overall municipal market or the high-yield component of the municipal market. However you slice it, that's really, really small. So we could see, I think it's an important environment for selection in areas like healthcare and areas like senior living and areas like higher education. Could see some more volatility, very important for selection and things like covenants to be examined very carefully. But overall, as a macro market, the characteristics of resilience, the monopolistic tendencies of these revenue streams put the asset class in good shape in 2025, I think.
That's great. Thank you, John, for your time. Appreciate it.